Sagaffi, Liberty Home Mortgage. What am I talking about today? I'm talking about, and I'm comparing the housing market today in 2022, I'm in the back end of 2022, to the housing market back in 2008. So many people out there right now, especially with mortgage rates and inflation being high. I mean, mortgage rates are at their highest level right now in probably, I've done this for 23 years, coming up to 24. So with all of the news of that, naturally, everyone's screaming gloom and doom and throwing out all of this misery out there, and it's terrifying everybody. And people are starting to compare this. Oh my God, is this 2008 all over again? Let me tell you this one. Hell no, okay? No, it's not 2008 all over again, and you heard it right from me. Watch all these people that are doing videos on, there's a housing crash coming. There's no housing crash coming, and I'm telling you that right now. I'm gonna compare today to 15, 20 years ago, whatever you wanna call it. Let's start with this one here, okay? From 2002 to 2007, 23% of the mortgages done in the United States were subprime loans. Today is nowhere near what it was back then. It's not even close. Since 2007, do you wanna know how many subprime loans have been done? 0. They don't exist anymore. They're gone. They've been gone for 15 years. Over a 5-year period from 02 to 07, 23% of the mortgages were subprime. When you start getting into what were called Alt-A's, which were good credit, but still loans that you can't do today, that would drive that 23% number up through the damn roof. Let me tell you what a subprime loan was, just to give you context or give you a picture here, okay? 581 middle credit score, 581 middle, no money down, 0 down, 60 days out of a Chapter 7 bankruptcy, which today, 581 no money down, you can't do. It's impossible. It's not even today. I haven't been able to do that loan for 15 years. 60 days out of a Chapter 7 bankruptcy. For 15 years, I can't do, just based on that, just based on the no money down, we still have no money downs, but you're talking about VAs, USDAs, you get in the down payment assistance, that's still not no money down. There's actually down payment, so I'm not counting those, okay? No money down, VA, USDA. 15 years ago, I could do no money down through conventional, FHA, whatever you want, okay? 581 credit score. For 15 years now, we can't even do that low of a down with that type of score. 60 days out of a Chapter 7 bankruptcy. For 15 years, can't even do that anymore. Currently in foreclosure on their house. 15 years, can't even do that. I did that loan back in 2006. 581 middle, no money down, 60 days out of a Chapter 7 bankruptcy, currently in foreclosure on their current house. I did that purchase. That has been gone since 2007. So for 15 years, we have not been able to do one of those loans, not one. Whereas 15 years ago, 23% of the mortgages done were like that. I'll give you another one. No money down, 0 down. Especially for the loan officers watching, put some comments in the section over there. Tell me what you think of this one. No money down, 0 down. 4-family, so it's a 4-family house. Investment property, the borrower was not going to live in the house. 661 middle credit score. So 661 middle, no money down, investment property, 4-family. No documentation. The only thing on the loan application was the name, social, date of birth, home address of the borrower. I didn't have where they worked, where they banked. I have nothing. It was no documentation. We verified nothing, okay? 0. That's been gone since January 1st of 2007. I should be telling you it's been gone since 2006. It's been gone since 2007, January 1. We have not done any of those loans in 15 years. We're at the receiving end of that now. For 15 years, that's what we've been doing or not doing. We're at the receiving end, okay? So don't try to compare housing today and homeowners today to the homeowners 15, 16, 17 years ago. It's not even close. That's one of the reasons why today it doesn't even compare to 2008. Let me give you a second thing, comparing today's market versus 2008. In 2005, I've got one of my charts over here, 35% of mortgages in the United States were adjustable rate mortgages. This chart here that I have is from the Mortgage Bankers Association. In 2022, you wanna know how many are? 35% in 2005, 2%. Today in the United States, 2% of the mortgages in the United States are adjustable rate mortgages. 2005, which led into 2008, 35% were adjustable. Today, 2%. Not even close. You want to talk about why Today's market is so much more stable, so much more steady, so much more dependable, and so much stronger. And if you're sitting here saying, should I buy a house right now? If it's the right time in your life, hell yes, you should. By the way, if it's not the right time in your life, hell no, don't buy. I don't care if rates go to 0% interest free, okay? But you buy when it's the right time in your life. You don't buy because you're trying to time the market, because interest rates are low. No, you throw all that garbage out the window, because that's what it is garbage. Anybody thinks any different, they don't know what they're talking about. And I'll challenge anybody on that, and I'll win every single damn day of the week. Let's go to this one. The Mortgage Credit Availability Index. So mortgage credit availability, the Mortgage Bankers Association, which oversees like all mortgage banking in the United States, very, very, very big group that's a lot of their data is looked at by housing experts, whatever it is. They have something called the Mortgage Credit Availability Index. Basically, it says how easy it is to get a loan. We have a chart of this. In 2006, the index was almost at 900. An index of 100 means it's traditional, steady, the way it's been for 50 years, okay? In 2005-06, 9 times more easier in 2005 to get a loan. You know what it's at today? 102.5. It was at 900 in 2005. 900. Today it's at 102, okay? In other words, it ain't easy to get a loan. You know how many people I talk to today who get so pissed off that I can't qualify them? But I'm not being a jerk. Here's reality. You want to know something? We're stronger. Our default rates are less. I'll go through more data here. Let's go through mortgage delinquency rates. In 2008, the delinquency rate was almost sitting at 8%. As a matter of fact, by 2010, you have to remember with modifications, HAMP, the Home Affordable Modification Program, HARP, the Home Affordable Refinance Program, all these programs that came out, it delayed foreclosures and things like that. So a lot of it got pushed into later years. 2010, the delinquency rate was almost at 13% delinquency rate, okay? By 2010, from the loans people like me gave, I gave these loans, 2002, 3, 4, 5, 6, 7, okay, 2003, 4, 5, 6, really, almost at 13% delinquency rate. Do you want to know what the delinquency rate is at today? Actually, today, the delinquency rate is just over 2%. Our delinquency rate in the United States on mortgages is right around 2%. We were almost at 13% delinquency rate back then. So when somebody tries to say, this is the housing crash coming, our delinquency rate's almost at a record low. This is almost the lowest the delinquency rate has been in over 50 years on mortgages, okay? Don't tell me today is like 2008. Let's do another one. Here in 2007, no money down conventional loans were eliminated. Before 2007, we had no money down conventional loans with no score requirements. Again, if you're a loan officer watching this, see if you can appreciate this loan that I did. I did this loan myself. I did it in Parma, Ohio. But I did this loan for somebody buying a house in Parma back in 2006. No money down, 470 credit score. So for all the loan officers, listen to me on this one. 470, Fannie Mae Flex 100. Fannie Mae had a loan, you ran it through Desktop Underwriter, it was called their Flex 100. Flex 100 because 100% loan to values, no money down. Fannie Mae Flex 100 had no credit score requirements. This customer had a 470 score. We went no money down on a $105,000 purchase, okay? Those loans are long gone. Let me give you another one, and this is a big one. Cash out refinances. We're comparing today's market to 2008's market. Cash out refinances. From 1998 to 2008, more than half of the refinances done in the United States were cash out refinances. People taking money out of their equity to do other things with. In that 10-year period, 8 out of the 10 years, more than half of the refinances, and many of those years, over 70% of the refinances done were cash out refis. From 2009 to 2021, because I don't have the data through 2022 yet, that's a 12-year window. The first window I gave you was 10. This window is 12. For the last 12 years, not counting 2022, 3 out of the 12 years have been cash out, more than half of them have been cash out refinances on the refinance side of it. So the truth of the matter is, for the last 15 years, My industry has not allowed people to tap into their equity to pull cash out. We've made it super, super, super difficult. Here's another thing. If you want to do that today, we limit you significantly, predominantly on first mortgage cash out refinances. You must leave 20% of the equity in the property. Back before 2007, and again, my loan officers watching this, back then, we had a refinance called a 125. I can give you a mortgage in which I would physically cash you out and give you 25% more than your home appraised at. So if your house appraised at $100,000, I can give you a loan for $125,000 against your house. Okay, those are not only gone, but think about it. Today, if your home's worth $100,000, I can only give you $80,000. That's a $45,000 swing on $100,000. Imagine what it is on a $400,000 home. My industry for the last 15 years has not allowed homeowners to use the equity of their home like a damn piggy bank to go and do God knows what with. And that is great, okay? Today's market is nowhere near what the market was 15 years ago. I've given you the data. 23% of the mortgages back then were subprime. Today, and for the last 15 years, it's zero. 35% of the mortgages back then were adjustable rate mortgages. Today, 2%. Mortgage credit availability, it was at 900 in 2005. Today it's at 102. In other words, it is hard to get a loan, okay? Mortgage delinquency rate was as high as almost 13% in 2010. Today it's at 2% and going lower than that. We've eliminated no money down conventionals, FHA with seller down payment assistance, cash out refinances. 8 out of the 10 years, more than almost all the refinances out there, more than half of them were cash outs. For the last 12 years, in this time period that I'm talking about, only 3 of the years it was more than 50%. And even then, it's limited to leaving 20% of the equity in your home. Up until 2007, when you could do 125% of the value of your home. Those are long gone. Now it's 80% of the value. These are statistically and measurably data that I'm giving you to prove today's market is nothing like the market was back then. Proving once again why home ownership and buying and owning a home is so strong and such a good thing to do, even in a market when inflation is high and interest rates are high. Even 6 to 12 months ago, when you did have to pay over the list price to get the house, at the end of the day, as a longer term investment, and I'm not talking 30 years, I'm talking 3 to 5 to 7 to 10 years, nothing beats owning a home, not counting what it does for your life, your family, yourself emotionally, personally, the neighborhood, the market, the cities you're living in. So, I mean, nothing compares to it. This is the comparison between today's market and 15 years ago. And at the end of the day, I hope you like this data and this information. Make sure you're following my YouTube page, subscribe to it, like, comment, and share it on your page. Share this information and keep following along. Catch my next videos that are coming up. We'll see you on the next one.